What's up, guys? Welcome to the Momentum Trading Lab. And in today's video, I'm going to show you how I use the ICT London Silver Bullet Strategy. All right, so let's first have a look at the rules that I follow. All right, so we are going to be looking for the fair value gap to form between 3 and 4 a.m. New York time or Eastern Standard Time. We are going to be using the 5 to 2 minute time frames, and I'll show you when we use the 5 minute and when we go down. And then we are going to be waiting for price action to do a liquidity raid. So we want to see price action sweep old lows or an old high, or price action can sweep relative equal highs or equal lows. So what do we have below lows is the sell side liquidity, and above highs we have buy side liquidity. So after the liquidity raid is completed, we want to see a market structure shift with displacement, and we want to see this displacement leg create the fair value gap that we will be using for our entry. So like this point says, we will be entering inside of the fair value gap in the displacement leg, and we will be targeting a 2-to-1 risk to reward ratio. All right, so before we get into the charts, let's just look at a visual representation of the ICT London Silver Bullet setup. So for a potential long position, we want to see price action trade into sell side liquidity. And like I mentioned, sell side liquidity will be below an old low or relative equal lows. And once it has traded into the liquidity, we want to see a market structure shift with displacement. So we want to see price action take out the previous lower high and create the fair value gap. And this fair value gap, we want to see form between 3 to 4 a.m. That is the ICT London Silver Bullet session. So after the displacement, we will wait for price action to retrace into the fair value gap. And for a long position, we will put our limit order right at the top of the fair value gap with our stop loss at the previous low. So entry right at the top, stop loss right at the previous low, and then we will be targeting a 2-to-1 risk to reward ratio. So simply if you put your stop loss right there, you just move your long tool until it says 2-to-1, and you will be targeting this setup every day, and then over time you will likely become profitable as a result of following the same setup every single day. Okay, so that was a potential long position. So let's have a look at a potential short position. So between 3 and 4 a.m., we want to see the fair value gap form. But before that, we want to see price action trade into buy side liquidity. And like we said, the buy side liquidity will be above an old high or relative equal highs. So we want to see price action trade into it, then displace to the downside. That takes out the market structure, so it shifts into a bearish market structure, creates a fair value gap, and then we will be waiting for price action to retrace into the fair value gap, and we will put our limit short right at the start of the fair value gap with our stop loss right at the previous high. All right, so that was the visual representation. Next up, we'll go into the charts and do a bit of backtesting. Okay, this is the first example of the ICT London Silver Bullet Strategy. So right before 3 a.m., you are going to be coming to the chart. You want to mark off using a box, mark off 3 to 4 a.m. Silver Bullet. All right, so now we observe what price action is doing. So as we can see, we had a high right here. So this is the buy side liquidity. The price action traded into the buy side liquidity. We don't have any displacement yet. So let's see what happens. Okay, so right there, we poked into the liquidity above this high as well. So that is a good sign to potentially go short. The next thing that we look for is the market structure shift. So after liquidity rate, we want to see a market structure shift. So for that, we have to look at the very last higher low. We have that right here. So if we displace below that low, that will be a bearish market structure shift. And now we want to see a fair value gap form right here. Okay, so it went even lower. Okay, so fair value gap formed right there. And see on the very next candle, came straight into it. So that would have tripped you in for your short position. Two to one risk to reward ratio. Okay, let's see how this played out. Coming back to the entry. That's not to worry. So you don't move your stop loss at all. You just keep it where it is. And then eventually you got your TP for 53 points on the NASDAQ. Right, that was example number one. Okay, we are at the next day. So let's just recap the rules. We are still on the 5-minute chart. So now we have to wait for a liquidity rate. So price action must sweep an old low or an old high. So let's mark off the liquidity pools on our chart. So right here we have an untouched high for the buy side liquidity. And right here we have an untouched low for sell side liquidity. Extend this a little bit. And then get our box to mark off the 3 to 4 a.m. time window. Okay, so we have the liquidity pools. We have our time window. So let's see if price action trades into the buy side or the sell side first. Okay, so it went into the buy side. So now that it took the buy side, we are looking for displacement to the downside. Okay, we have displacement to the downside. Took out a low, so let's mark off this fair value gap on the 5-minute chart. And if it displaces to the downside, you can go to a lower time frame. For instance, let's go to the 2-minute. And on the 2-minute, we can see that there's a low right there. Price action took out the low. So that is the bearish market structure shift. And you can also see the fair value gap on the 2-minute. So now we know we have a valid setup. Okay, so we are targeting that fair value gap. Stop at the high. And we are targeting a 2 to 1 risk to reward ratio. Just like that. Let's see what happens. Okay, so right there, tripped us in, didn't take us out. So let's see if it goes to our TP. Boom, right there for 35 points on the NASDAQ. Right, so that's been the second example. Okay, this is example number 3. So just before 3 a.m., we come to the chart. We mark off the silver bullet time window from 3 to 4 a.m. There we have it. And then the next step is to mark off the potential liquidity pools. The buy side above old highs and sell side below old lows. One thing to consider is that we traded into the liquidity above this high and we started to move down. So if we start to displace below this low, that will be a bearish market structure shift. And provided it creates a fair value gap, we can use that for our trade entry. So let's see how this plays out. Okay, so instantly right at 3 a.m. displacement below this low. So this is your bearish market structure shift with the fair value gap right there. So this would have been your entry with your stop loss. Right at that high, we have a lower high and a lower high on either side of the candle. So that is a valid high that we can use for our entry model. The 2-to-1 risk to reward ratio. Yeah, and let's see how this plays out. Okay, so this one came and stopped us out, and that is fine because no trading strategy is going to give you a 100% winning rate. But because we have three different silver bullet time windows, the first one is the London one from 3 to 4 a.m. Then we have the New York one from 10 to 11 a.m. If you haven't already, check out my silver bullet video for the New York session. I'll pin it to the top of this video. And then we also have the afternoon session from 2 to 3 p.m. All right, that's how I use the ICT London Silver Bullet strategy. If this video provided any value, please remember to hit that like and subscribe. And then I'll see you guys in the next one.